All right, let's get started. I'm Amit Seru. I was faculty here for 9 years, and I was remembering my first talk in a different room. And the one thing you realize when you're giving a talk at Chicago is that time runs faster than you think. And the two gentlemen here actually spoke more than I did in my job market talk. So I'm pretty sure that we are going to consume this time very quickly. So we have Doug Diamond and Luigi Zingales. And I think we should have the more provocative person go second. Just by chance, Doug, you should go first, I think.
Okay. So as I was saying, I wasn't aware there was a Chicago School of Finance. I don't think there is. The Chicago School of Finance is sort of, try hard to do it right and don't overclaim. So there is modern finance, right, which is pretty much done, with an 80% market share from, people like Gene and Mert. But it's not particularly, there's not like a particular approach to doing finance here. There is a Chicago School of Economics, which I knew about. So I came here from Yale Economics. So Steve Ross and Jim Tobin and actually Martin Schuvick were my advisors. So I thought this place was going to be like totally different, but it wasn't all that different. So the Chicago School thing was a little bit of a surprise that it was supposed to be so different. So let me talk about the Chicago School before 1962. That way I don't have to say whether Gene is part of the Chicago School or not. Gene tends to go with the data, so I don't know if he fits in this. He certainly agrees with a bunch of these people. So these are the people I can sort of think about in the Chicago School. The two people at the bottom are a little younger, are a little bit more recent to Chicago, Mert Miller, and then Bob Lucas when he came back on the faculty. I'll talk about the Chicago plan in a second. There's the Chicago School. So basically the main thing I think about is its sort of price theory and its application. You take micro theory seriously, it explains the world. You take it to the data, it explains the data. There's a Chicago plan that was this, I'll talk about it in a second. Raghu mentioned it as well. By the way, we're decentralized here. Raghu and I didn't know we were both talking about this. That was 100% reserve banking, which is actually what I'm going to talk about today. Monetarism and the problems with discretionary government policy, that was sort of part of the Chicago School. And a big one is sort of government failure versus market failure. There was lots of people who were concerned about market failure. Stigler and essentially all these other people were concerned about government failure as well, and it ends up being a trade-off. Most people's priors probably it's like 90% government failure, 10% market failure, but it depends on the problem. Okay, so I'm going to talk about the Chicago plan, which is sort of intended, I think, as government failure versus market failure. So my task was to talk about open questions, things we don't know. So that I take that as things I'm confused on, I can make you confused on as well. Several of my colleagues roughly a year ago said sometimes I would give them advice that would take them 2 weeks to figure out what the hell I was talking about. So that's why Luigi picked me to confuse you and the others here. So I'm good at confusing, but this is hopefully enlightening confusion. Okay, so not everybody on that group signed in the Chicago plan. There was actually a written document, but certainly it had a lot to do with Jacob Viner, Frank Knight, Aaron Director, Milton Friedman, Henry Simons. And actually, Merton Miller obviously didn't sign it, but there's a famous paper of Merton Miller's called, it's not so famous, it's like, but Does the Modigliani-Miller Theorem Apply to Banks? And there's an abstract, yes and no. So it's a very short abstract. And then essentially what he says there is that there's no particular reason that the capital structure of banks should matter, but then he sort of cites there's this thing, the Chicago plan, well, if you just leave them alone, they tend to fail a lot and things like that. So one very good thing about the Chicago plan, which I'll talk about in a second, is you could get rid of all the damn bank regulators. The banks would just be holding, Treasury, holding Federal Reserve deposits, and that would be their only asset. And then he also mentioned that would get rid of all these stupid banking economists, which I hope was not referring to me. But that's what it is. Okay, so I always thought this was a fairly extreme proposal that didn't make tons of sense to me. when you think about the people here who are in favor of it, I think probably I dismissed it too quickly. So the thing I'm going to talk about today is maybe this isn't so stupid, but to bring it into the modern terms, the modern world, you have to think a little more broadly. And there's a lot of stuff been going on thinking about how financial markets and things like that might not do so well in allocating resources because of various externalities. So I'll think about how the Chicago plan might relate to some stuff, some recent stuff. Okay, so the possible goal, so in addition to all these people, James Tobin, who was one of my advisors, who's certainly not a Chicago school person, and Irving Fisher, who probably, he was another Yale person, from previous generation. So the fact that those guys and all of these people here are in favor, so maybe the Chicago plan needs some more thought. Okay, so if you read the various papers on this, the big one is to avoid big decreases in the money supply caused by bank failures. That was actually mentioned in the Chicago plan, and it was mentioned by Irving Fisher when he's talking about 100% reserve banking. That's his big one. That's the whole point. That's the mechanism in Friedman and Schwartz on how bank failures actually cause trouble. Another one that gets talked about is avoid excessive volatility in credit and remove the link between the money supply and the volume of credit. So if you sort of need to collateralize deposits with loans, then if the volume of loans moves around, then the money supply moves around. So that's a little like the real bills doctrine, which people sort of repudiated. Another one that's more recent, avoid bank failures, avoid bailouts, or even better, avoid the dislocations from bailouts. This is the one Merton Miller mentioned, avoid the need to regulate banks, because if banks are illegal, you don't need to regulate them. All they have to do is hold government deposits. And then maybe avoid the need for banks. If banks are this is related to Gene's question, if banks really aren't doing anything but they're causing trouble, getting rid of them would be an excellent policy. So this comes up a little bit in talking about central bank digital money, digital currency. So or we could think about the narrow bank that Jamie McAndrews was proposing. He used to be the head of research at the New York Fed. He proposed that you just set up a bank, and they, in their charter, says we'll put all the money into interest on reserves at the Fed, and then we're going to have safe deposits. So if you think the banks don't really do anything, this would be a good idea. So one way to think about, the pluses and minuses of 100% reserve banking, if you thought just having central bank digital money competing directly, say without the Jamie McAndrews bank, if you think that was a good idea, that making these compete with the other banks maybe would just drive them out of business if they're not doing anything useful. Okay, so Raghu mentioned this. I'll go through this quickly. Banks do other things than just create money. They make loans to small and medium businesses. They create liquidity, which is a little different from creating money. It's not just about means of payment and things like that. There's commitment, which Stu and I and Raghu were talking about that a minute ago. So then the question is, what would happen if we tried 100% reserve banking? So most of the proposals, and if you read the original plan, would be the idea is if you got rid of the banks financing themselves with debt, we'd have replacement intermediaries that were all equity. So if that was the outcome, and there was nothing good about this fragility and this debt and things like that that's financing loans, it would just be a wonderful thing. But it's and this is sort of the point of a paper of mine with Phil Dybvig in '86 in the Journal of Business, is if the banks are actually creating liquidity, if the banks aren't allowed to do it, creating more short-term debt, unless the government fills in with lots and lots more short-term debt, then there's going to be a vacuum. The general equilibrium will find it profitable to borrow short and lend long, and with the liquid stuff and the replacement intermediaries would just end up having the runs on them instead of the banks. And then these people presumably would be unregulated and things like that, so then you have to give them deposit insurance and give them regulation. So maybe that would be a problem. So 100% reserve banking, unless it's the case that it really doesn't the structure doesn't make any sense, basically needs tons and tons of regulation. So like when I will tease some of my, every time after a financial crisis, people say, let's just get rid of banks and we'll have 100% reserve banking. Happened in Japan after their lost decade, happened here. So essentially, when I was talking to one of my former colleagues, so basically, you're involved, you're requiring this tremendous deep regulation that essentially to work would have to regulate the capital structure of firms, banks, et cetera. So if that's true, then this is an extreme thing. So only way it would be effective is if you regulated everybody's capital structure, and maybe that's the right thing to do, but you'd better think that somehow, what is it besides panics and things like that you're concerned about? And basically there better be externalities floating all over the place. So if you think to make 100% reserve banking, you have to regulate capital structures of everybody, then you'd better have a big problem, because that's extreme regulation. Okay, so if we say, what kind of things could we bring to, what are the ideas that are floating around now that might have us have a little bit of sense that we can answer these questions? So you could imagine that Modigliani and Miller held in the aggregate, the capital structure as a whole of the economy doesn't matter. Okay, I don't think Mert certainly didn't believe that. So the idea is that, in fact, the best proofs of the Modigliani-Miller theorem, like the Joe Stiglitz one, basically says there's an aggregate capital structure. Firms can do whatever they wish, and the role of financial intermediaries who do nothing else is to fill in the gap between the optimal aggregate capital structure and the one the firms choose. And on each individual, this is sort of like anybody in a competitive market doesn't really have to get the right quantities of chocolate versus vanilla ice cream, because the market will get the quantities right, because it's perfect substitutes, perfect competition. Okay, so it's probably, unless you believe Modigliani-Miller in the aggregate, which only some macroeconomists who don't think about finance believe. Harold was here before, I should be careful talking about macroeconomists, but he doesn't believe that. So unless you believe that, you need to go a little further. So there is this empirical work on convenience yields of public versus private safe debt, which usually means short-term debt. So Greenwood, Hansen, Stein, Krishnamurthy, Visling, Jorgensen, William Diamond and Van Tassel have a paper on that. So does seem to be that the amount of short-term debt in the economy matters. So if you're going to make the Chicago plan work, you'd have to have the government make sure it produced the right amount of short-term debt. But if you take the view that Raghu and I were taking, that maybe this is a natural thing, and it's a complement to the things that banks do, maybe you got to think about that. But let's imagine that's not true. It basically, you need financial regulation somehow if you believe this story. So maybe the private sector issues too many money-like securities. Maybe there's just externalities from issuing stuff that needs to be refinanced into a common pool of liquidity. Whenever the market's not complete, that could be a problem. Guido Lorenzoni on our faculty has a lovely paper that sort of makes that point very clearly. So if the market's complete, two things are true. If the market's complete, you don't have to worry about pecuniary externalities. If the market's complete, firms can choose any damn capital structure they want, right? Because they're not creating securities. All they're doing is adding up the prices from the securities that are already there. So you need incomplete markets to actually have any of this stuff go on. The only reason you'd need a Chicago plan if there were complete markets is because there was some government subsidies from bailouts or something like that you were trying to get rid of. So the other thing, which is a little different from this pecuniary exercise, is maybe there's just too much private short-term debt. If you take the view that Raghu and I take, that short-term debt is a commitment device to make sure you don't give too big bonuses and to make sure you repay, you're sort of building in a doomsday machine to yourself, right? So today, if I can't pay this, everybody's going to run and we're going to cause some trouble. So that's an externality that's very similar to just the fire sale one, you're just selling into the market. But you could imagine if the stuff we're saying is relevant, you want to build in this doomsday machine, I might do too much of that. So I might need capital requirements just to get the cost benefit lined up to deal with those externalities. So if you get in, so this is why I'm saying I'm going to make you all confused. So basically, if you get into this line of argument, which I think has some sense to it, that basically you got to think about how liquidity and monetary policy affect corporate finance. Via general equilibrium effects, it's not figuring out what the beta is or something like that, or the Fama-French risk factors of a firm are to figure out what the expected return on security is going to be. It's going to say these things about creating the liquidity and issuing long-term and short-term and senior and junior. That's the corporate finance sector pushed together with the banking sector. So if these things are problems, they're problems for all of them. They may not be problems. It could be this is just the invisible hand takes care of this. In which case, the Chicago plan is not as long as you get rid of the subsidies, is not really needed. So corporate finance and financial intermediation sort of come together. So in developed markets, that's creating too many or too few money-like safe assets. That's the stuff I mentioned in that empirical work. In developing economies, the corporate sector, as well as the banking sector, actually creates securities. It's one of their products. They don't just do investment; they create securities. Raghu and Yanja and I have a paper which had better be finished soon, but we've had all the drafts for over a year. I was busy last year somehow, I don't know. But we've had this paper for a while that basically says that in developing economies, financially poorly developed economies, like in the LLSV sense, this is another product this is another source of rents to firms. So there's also this stuff on overlending and credit boom, Shalaric and Taylor, and the Amr and Atif stuff, even in the US, that basically suggests that maybe the private sector creates too much volatility in credit, too much volatility in investment. So if that's a problem, then we got to think about it not just in the banking sector, but the corporate finance sector. And then debt and redistribution between highly levered entities, think banks, and less levered people who are let's say more pessimistic or more risk averse during booms. This redistribution, that's the stuff Johnny Giannakopoulos has been worried about. I think if that's enough of a problem, that works as a pecuniary externality we need to worry about. So basically, in summary, I guess my time is almost up here. In summary, this set of problems is something that people in finance theory and economic theory are worrying about a lot, and maybe we should think about the Chicago School approach as in that framework. And maybe it wasn't such a stupid idea after all, given the quality of the people that thought it. Okay, last thing I'll say. So instead of just saying stuff I don't know, here's something I hope I know something about. So that basically, the alternative to stuff like the Chicago School, like the Chicago Plan, or stuff like putting capital requirements in, is just improving the supervision and regulation of banks. Instead of outlawing them, try to keep them from turning into doomsday machines. So when they're incomplete rules with limited commitment and political interest, isn't going to work very well. Amit has a lot of work on this. So basically, the idea is that in the delegated monitoring paper of mine is that the depositors don't monitor the bank, right? And then that's because the bank does the hard monitoring. There is some sort of obvious stuff to make sure the bank has enough capital or the bank is diversified and things like that. You don't want every depositor to do it, but it's obvious. It's like hiring an accountant. It's like a set of rules that are followed. So that's what supervisors are supposed to do. So supervisors really screwed up in the recent periods. So basically what happened? We improved the regulations. We discouraged banks from having lots of illiquid assets. Because we troubled with illiquid assets in the great financial crisis. So what did the mid-sized banks do? They loaded up on liquid assets and took interest rate risks to pick up 90 basis points of spread. Okay? And then why did they do that? It's because they had this hold to maturity accounting and they didn't have to mark this stuff to market. So they're going to say, if this happens and we get undercapitalized, the regulators are not going to bother us. Supervisors aren't going to because these things are, probably the US agency securities are not going to default. So then people find out that they're insolvent. If there's going to be a run on uninsured deposits. So people find out they're a little bit solvent. Then there'll be a run. Amit and co-authors have a nice paper that says this. It says, suppose you have liquid assets that are worth less than par because interest rates went up. They're liquid, and their true market value is less than par, and par is the value of your deposits. Everybody stays in, you're fine. Everybody gets out, they're broke. So you can get a fear of fear itself run on liquid asset banks. So this basically says to help commit supervisors and to do their job, we need to use market values in supervision. Regulators, supervisors hate market values. It's like it's like Hertz recommending Avis or something like that. It's not their mantra. But for liquid securities, it's really a disaster not to do it. So that's what I have to say. Thank you.
So it's a great thing, I believe, in comparative advantages, because if you believe in absolute advantages and you're in a panel with Doug, you shut up, okay? Because he's better at everything. So I decided that I'm not going to talk about banking, that's for sure. I decided I'm going to talk about corporate governance. Now, this is a bit challenging because, of course, a lot has been done, and Steve had a wonderful survey of the major contribution that many in these rooms and many that should have been in this room and unfortunately are not with us contributed to corporate governance. So it's a little bit challenging to say this is a session about open questions. What are the open questions in corporate governance, given that so much has been done in the past? Now, one thing is that corporate governance is a little bit like growth. Lucas used to say, when you start thinking about growth, you can't stop thinking about growth because growth is so important. I claim actually corporate governance is even more important than growth because corporate governance leads you to better growth. So I think that is important, is a big chunk of the economy. And I interpret actually corporate governance a little bit more broadly than what Steve does. I think about the way firms are run. And this is important not only because it makes shareholders rich, but also because hopefully makes society better off. So I think that that's the perspective I will take. And here, there is a fundamental tension that jokingly I say when Friedman met Stigler. Now, of course, for those of you who are younger, they were not only colleagues, but friends, and they were spending every lunch together at the Quad Club. So it's particularly interesting that there is this tension that goes unresolved, and has gone unresolved for the last 50 years. Because Friedman, in his very famous piece, in 1970, of course, he has written before in 1962, but nobody read it then. But when he finally wrote it in the New York Times, then everybody read it. And he says that firms should, and managers, the social responsibility of business is to make as much money as possible. And he was smart enough to qualify this while confirming to the basic rule of society, both those embodied in law and those embodied in ethical customs, which sounds great. Except that his friend and colleague Stigler just at the same time wrote that actually those rules that you have to take as a constraint are really acquired by industry and designed and operated primarily for the benefit of industry. And so now you have kind of a short circuit because you say, wait a minute, then is the social responsibility of a CEO to capture the regulation and the legislation to maximize shareholders' value? Is it really what we are saying, that that's what it is, especially if you take the broader view that is not just regulation that might be captured, is legislation, is even the enforcement, is the definition of property right, is everything we call institution. So should a manager really maximize that? So let me give you an example. We know there are private prisons, and private prisons are very effective in influencing longer sentences. Now, occasionally do the old-fashioned way by bribing. This is a case of two judges in Pennsylvania that were literally bribed by some private owner of pensions to sentence young kids for longer period in jail. Now, this is horrendous. Thank God they've got caught, they got to jail, they threw away the key. So I think that that's good, and it's relatively rare. What is much less relatively rare is the other form of lobbying. We know that private prisons use lobbying to encouraging longer sentences, and will increase the amount of people spent in jail. And there are now papers documenting that indeed, I think that this is enough, documenting that in places where you have more private prisons, you're going to have longer sentences done by judges. And this is not just an availability of incarceration places, is because they control that this doesn't happen when there is a public prisons. And similarly, there is evidence that if you are an inmate in a private prison, you spend 90 days more in jail with no benefit whatsoever in the term of long-term redemption as a criminal. And now you say, like, 90 days is not that much, but actually, first of all, 90 days in prison, so try them. And second, they are kind of 8% increase on the amount of sentence, so it's not a trivial amount. Now, not only there is of course, lobbying, there is the issue about what does it mean to conform to the law. Now, the speed limit on Lakeshore Drive, in case you don't know, is 35 miles per hour. Now, who does conform?
45.
No, it's 35. In some pieces, it's 35. Even you don't know. Okay. And now, who does conform to that? Now, I remember that Angel, when he was a faculty member here, he had a speedy car and he had sort of radar detector to try to avoid it. So, are managers required to push the limit of the law, past the limit of the law? Are they required to do everything in their power, including that radar detector? Should we take the Beckerian perspective that, after all, the law is simply an option to pay a penalty, right? And so is comparing the cost of conforming and non-conforming. So the only thing you pay attention is what is the cost of non-conforming. And doesn't really matter what they're doing. So is really the fiduciary duty of managers to corrupt our government, pollute our environment, and jeopardize our safety when this is profitable? That's the question I have. Now, of course, they say this doesn't happen. So let me give you a few examples. So this is actually a beautiful movie about DuPont. DuPont actually dumped a substance they knew was toxic in the Ohio River, killing hundreds of people. And they did it with a purpose intended to maximize profit. There is even a cost-benefit analysis they did in 1984, and they decided to go ahead. Now, in 2000, when 3M told them, the stuff we sell you is poisonous, we stop producing, they doubled down a second time around, okay? Now, Steve said this is in the past, and it's not happening anymore. Now, Volkswagen, there's nobody like the Germans to do it on a grand scale, okay? So if DuPont only killed hundreds of people, the estimate is that the extra emission of Volkswagen killed thousands of people, and was done only a few years ago. And basically nobody went to jail except one who did not pass the IQ test because came back to the United States to go to the Keys and got caught. And was so shocked because in Germany, managers don't go to jail, okay? Not even very much in the United States, but certainly not in Germany. Now, the one on the lower end, you don't know it probably because is actually an Italian bridge that collapsed 5 years ago, killing only 43 people. We're lucky that day not a lot of people were on the bridge because the bridge is a mile long, so and there are houses underneath. And why did it collapse? Because of under-maintenance of the bridge itself, and of course saved a lot of money, and the shareholders made a bundle out of that transaction. And in case you think that this is only rare, this is the leftover of a Boeing 737 MAX. That's the one in Ethiopia. Now, the board of directors of the Boeing knew, especially after the first crash, that there was a device that was dangerous, and they kept quiet, okay? I repeat, they kept quiet when they knew there was a problem, they blamed the pilot that was not fast enough. The pilot had 10 seconds to fix a problem that could kill everybody. And they say, you're not fast enough in 10 seconds to understand what is going on because they didn't provide training. Why did they not provide training? To maximize their sales. Now, with all due respect to Gene, you think that people like this pay for their reputation? Absolutely not. Jim McCurney was the CEO of Boeing who actually did all that plan, and he's heavily a consultant in private equity, and he's actually on the board of trustees of Northwestern University. So how can you be trusted more? And in case you don't know, Carolyn Kennedy was on the board of Boeing when they kept silent. And as a punishment, what happened to her? She was appointed by Biden the ambassador to Australia. Now, in the old days, Australia was a penal colony and you were sent there to expiate your sins, but I don't think that was the purpose. So you get away literally with murder, okay? So are externality important? Now, I think so. This is why it's an open question, because the majority of the profession does not think that. In fact, the Kent Center, one of the sponsors of this conference, actually ran a survey, and one of the survey was, having company run to maximize shareholder value creates significant negative externalities for workers and communities. Now, the sentence I have to say is a little bit ambiguous what it means, having companies run, but let's take the interpretation. If you have a for-profit company and you increase the incentives to maximize profits, are you going to have larger externalities? What I just showed before seems to suggest that that's the case. When you look at the answer, basically, the vast majority of people strongly agree that, strongly disagree with that statement. There are only a few people who agree. The 20% are uncertain. So, vast majority of the finance profession thinks that you don't have externalities or they're not important. I think that that's a question that needs to be resolved, especially in light of the fact that in the last 40 or 50 years, in part thanks to Chicago, we have seen a tremendous increase in focus on shareholder value maximization. This is from a paper that I had with Babu and Pietro Ramella, where we look at how companies present what they do to their shareholders, and you can see that in the early 50s, not many companies were mentioning even the idea of maximizing profits. By the late 90s, everybody had some form of profit maximization, and a big chunk of them was using, in fact, the sentence that you maximize shareholder value. And you saw the impact of that. You saw the impact on compensation. This is a pool data between the information that comes from a paper by Carola Friedman for the early days, and then exactly compassed that later on. And this is simply the percentage of compensation that is stock-based. And you see a dramatic rise since the 1980s that makes managers much more interested in maximizing profits. And this is from Steve. This is the amount of money in private equity. We know that private equity, we learned from Steve, that in private equity, there are a lot of very strong incentives, and the fraction of the country that is run by private equity managers is increased tremendously over this period. And so the question I have for all of you is, we know there is plenty of evidence that if you take an apple picker and you give better incentives, they pick more apple. Okay, that's a foregone conclusion. There is a paper by Lazia on production of glass and so on and so forth. But you know, apple picking, the margin of improvements for cheating are quite limited. If you put me in a soccer field and you give me a strong incentive to win the game, I'm going to try to think about what margin do I have to cheat. Because I'm not a good soccer player, and the only way which I can win a game is by finding a right angle. And so the question is, when you motivate massively top managers, are they really spending their time into thinking about how can they make a better product or reduce costs? Or are they thinking about how they can manipulate the government and cut on costs when maintenance that is essential and so on and so forth? And I think that this is really the question that I have. And so to what extent we see not just increasing profitability, but increasing productivity of companies, and to what extent we see negative externalities. And because I'm not presenting a paper here, but open question, I'm going to use a little bit of Kaplan-style facts or evidence. So how does the Kaplan-style evidence is? First of all, you show the picture of return on asset. His picture of return on asset are always going up, okay? This is not mine. This is of a student of ours, James Traina, and shows actually return on assets of publicly traded companies have gone down, okay? Now, it's not my evidence. We can discuss. Okay, but I say, okay, but I say that return on asset does not seem to have gone up, okay? Which is what you expect with all this government going up. Now, look at the increase in output per worker. Output per worker, if you compare before 1980 and after 1980, you do any statistical test you want, you cannot see a difference in improvement. So it's hard to tell we have seen a major improvement there. What about, on the other side, on the negative externality side? Now, Zingales had a paper showing that when it comes to private universities, they are a freaking disaster. Basically, they are an organization to suck up money from the government. Very effective in sucking money from the government, very ineffective at graduating people who actually get a job after. Okay? So in that case, maybe is biased because we work in a non-for-profit institution, so we might be biased in our analysis, but for university, that's not a good idea to try to maximize profits. It's not true for retirement homes either, because if you are in a retirement home, actually, we are getting older, so we need to be careful on where our children will put us. And I will have a provision. Please don't put me with a private equity run fund because you die faster. Okay? That's what Zingales again proves. And if you run a hospital, you don't necessarily kill more people, but you suck more money out of Medicare and Medicaid in a very effective way. This is a paper by Liu. So the question I leave for you to discuss and for the younger generation to deal with is this increase in paper performance good for society? I think that Steve and others prove that from a shareholder point of view, it's been a boondoggle, but is it really an incentive to add value or an incentive to lobby harder and extract more rents without producing more value? Thank you.
Okay, perfect. We have 5 minutes, and I was very worried that we won't have enough provocation from you. So why don't I hear from someone else, and then I will go to you, Steve. I know exactly what you are going to say. Anyone else, especially from the younger generation, who has barely spoken? Eric?
Which Eric? There are two of them.
They can
Eric
decide.
the younger. Right?
Yeah. I guess to Luigi, I guess I sort of wonder whether you would prefer a world where the objective was broader, and so it was like world utility maximization, or one where there was more governance on the inputs or the choices of managers and stuff. Because I'm thinking about, SBF's desire to make a bunch of money to give to save the world, but willing to do all kinds of crimes in order to do that.
I'll ask a quick one. So Doug, you used the phrase market failure versus government failure, which is a phrase that's been, I've heard a lot here in my 15 years, and it's seeped in. I wonder if you have a conceptual way of thinking about market failure versus government failure, or if you're sort of markets fail, governments fail, it's a miracle anything works. Do you have a conceptual way of thinking about both in the same breath, in the same framework?
Question.
Okay, yeah.
Let's take one more. Given the lack of provocation, I need some more questions here.
Yeah.
Just getting back to the Boeing's example, to what extent do we know that CEO knew and the board knew that that was going on? So to what extent it's pay for performance versus closing the eyes, making sure kind of engineers mess up stuff to make the company profitable, and we just don't want, CEOs just don't want to know about it. So pay for performance versus observability of negative action. Thank you.
Did you want to take a stab? Because then I'll go to this side and I know it's going to stop at Steve. And then-
Sure. So let me answer the two questions and I'll let Doug. So on the information, I think that there's been litigation with the board of Boeing settled for, I think if I remember correctly, 260 million, of course, paid out of our money because we all invest in the S&P and so pay with our money, not with their own. And they did know, especially after the first crash. After the first crash, they did know that there was a problem. They kept it quiet. But even before, I think willful ignorance, and a lot of people invested in the Madoff fund, not because it was stupid, because they thought that he was front running on his brokerage account. And they didn't ask the question because they didn't want to feel accomplished. And so I'm not so sure that that's much better than the fact that they didn't know, but they want not to know to have a plausible deniability. In fact, I would say that's even worse. On what I want, I think the privilege of having the open question is you don't give answers of that type. No, it's a very good question. Jokes aside, I think it's a very good question. I think that broadening the horizon is important, but I don't think it's the only solution. I think there are, of course, a lot of other things going on, but one thing I didn't have time to discuss is also it's much easier to write contracts on profits than to write on anything else, or on stock prices. So in a simple sort of Olmston-Milcom model, we overdid it on that dimension, and we need to rebalance. So I'm not saying that we should not motivate people. I don't want to, so you come across in that, absolutely not. I'm just saying that, especially at the very top, very, very strong incentives. I said it for myself, and to say, if you are incapable, but you have a very strong incentive, you try to find an edge.
So I don't have a great framework for that. I mean, market failures, externalities, things like that. We understand government failure is some combination of capture, incompetence, and poor incentives of the government officials. Or like, if you're going to pass a law, you might pass a law that deals with the symptom and makes the actual problem worse. So anything where there's a market failure and you try to fix it, government failure is big enough, it says you might just, maybe it's better off leaving it alone because the cure is worse than the disease. But that's not very deep. So.
Everybody's tired? Okay, so then Steve, you close the show. And this is not going to be controversial at all, so we'll resolve
Luigi. So let me start off by saying, what Luigi did, which is what a lot of the press does, is they give you very selective results. And he's picked a few examples, which I'm going to rebut several of them. So first of all, on the private equity side, every paper that uses a large sample finds that productivity goes up over time. And that's, so let's look at the Zingales papers. The nursing home paper in particular, they never look at whether the deals made money. And they make the point, their conclusion is private equity can hurt people in the nursing homes and still make money. Those deals lost money. I mean, I went and looked at the individual deals. They were either bankrupt or, one case they made a little money. They were mistakes. And if you look at those deals, they were pre-GFC. There's another paper that looks at nursing homes during COVID, finds that people in nursing homes died less during COVID if they were private equity owned than not. And so, that's that they were safer. So you want to look at the typical deal, and the typical deal is actually successful. On the ROI, I'm not sure. We know profit shares are up everywhere across the world, and including in the U.S. So the profits relative to wages have gone up. So you would think margins have gone up. So I don't understand that graph. What? I'm going to keep going. I got two more. And again, Luigi seems to think people are dishonest. Maybe it's because he comes from Italy. There are really large reputational costs. The executives of Volkswagen all got fired. The Boeing people who were there, not McNerney, he was no longer CEO at the time. At the time, the CEO got booted, and there was a huge amount of turnover both on the board and in the company. And the person who's running it now was sort of someone on the board who took over and is cleaning it up. And then the two last things I'll say are more global. globally over this period, you say it's not been successful. A lot of the reason, you saw movement over time to India, China, elsewhere, and the number of people in poverty over this time we know has declined hugely over the last 40 years. And the US and Europe have been hurt a little bit like that in the middle, but the number of people who are starving is way down. And that's because, a lot of it is because corporate stuff led by these value maximizing people you don't like put stuff in these countries that actually had positive externalities on those people, in my opinion, because they're not starving. Now, maybe you'd rather have them starving. And then the last point I'll make is, what is your alternative? Would you rather have unions? Public sector unions have destroyed Illinois, and would you give them more power? Would you give government more power? Our legislators are doing a great job. And then the regulators, you would give more power to regulators, but then they're captured. How do you stop them from being captured? And who would they be captured by? They'd be captured by the big players. So you'd get big players rather than smaller players. And I think that would hurt. So I'll stop there.
All right. So I think, this is what Raghu meant by the tent in Chicago is big and scope for lots of disagreement. And Kaplan and Zingales wrote together, in case you didn't know that. So I think on that happy note, I think we got to stick on time. So thank you both, and thank you.